In 1929, Joseph Kennedy got out 6 months before the crash and made millions shorting the market. In 2008, Michael Burry bet against subprime and made $700 million. In 2025, the same pattern is playing out. Same 4 stages, same investors positioning. And you're about to see what they're doing right now that most people don't see. There's a pattern in financial history that repeats every time markets reach extreme valuations. It's not random. It's not luck. It's a 4-stage sequence that the same type of investors follow with mechanical precision. While ordinary people hold stocks all the way down, losing everything, a small group positions themselves to profit massively from the collapse. Warren Buffett is sitting on $325 billion in cash. Jeff Bezos has sold over $13 billion in Amazon stock. Mark Zuckerberg has dumped billions in Meta shares. Insider selling is at levels not seen since 2007, right before the last crash. This isn't conspiracy. This is documented strategy. The positions are public record. The patterns are historical fact. But here's what that viral video claiming this pattern won't tell you. While it contains some accurate information, it's wrapped in dangerous fear-based rhetoric that cherry-picks history, ignores survivorship bias, and presents unpredictable events as certain outcomes. Today, we're going to break down the real story. What's actually true, what's dangerously misleading, and what you should actually do with your money. First, let's understand what this 4-stage pattern actually says. Stage 1. Smart money exits 12 to 18 months before the crash. Kennedy selling in 1929. Burry buying credit default swaps in 2005. Buffett sitting on hundreds of billions in cash right now. Stage 2. Buy volatility insurance 6 to 12 months before the crash. Put options, VIX calls, credit default swaps, paying premiums for protection before disaster strikes. Stage 3. Short specific sectors 3 to 6 months before collapse. Target the most vulnerable industries. In 2008, that was subprime mortgages and over-leveraged banks. In 2025, commercial real estate and regional banks. Stage 4. Buy at maximum fear. Deploy cash when everyone else is selling. Kennedy buying distressed assets in the Great Depression. Buffett investing in Goldman Sachs in 2008. The moment fortunes are made. On the surface, this sounds compelling. It's got historical examples, big names, a clear framework, but here's where we need to pump the brakes. Let's separate fact from fiction. Some of this information is accurate. Buffett's cash position. Yes, Berkshire Hathaway is sitting on approximately $348 billion in cash and equivalents as of 2025. That's a record. And yes, Buffett has been selling significant portions of Apple and Bank of America stock. But here's what the viral video doesn't tell you. Buffett himself wrote in his shareholder letter that, despite what some commentators currently view as an extraordinary cash position at Berkshire, the great majority of your money remains in equities. He's not panicking. He's being patient about valuations. Commercial real estate challenges. This part is real. Approximately $2 trillion in commercial real estate mortgages are maturing between 2024 and 2026. Office buildings are facing serious stress from remote work. Vacancy rates in major cities are genuinely concerning. The rate of troubled commercial mortgage loans has risen from about 7% in early 2024 to over 10% by early 2025. Some insider selling. Yes, Jeff Bezos, Mark Zuckerberg, and others have sold stock, but they always sell stock for tax planning, for diversification, for liquidity. Bezos selling $13 billion sounds dramatic until you remember he's worth over $200 billion. That's about 6% of his wealth, not exactly abandoning ship. Market volatility in 2025. Markets did crash in April 2025 after Trump announced aggressive tariffs on what he called Liberation Day. The S&P 500 dropped significantly. Fear spiked. But then what happened? Markets recovered. By late June 2025, The S&P 500 and NASDAQ hit all-time highs. The inevitable crash didn't materialize the way the theory predicted. Now let's talk about what's wrong with this narrative. Problem 1. Cherry-picked history. The 1929 crash and the 2008 crash were fundamentally different events. 1929 was caused by excessive leverage, weak banking regulations, and a subsequent policy disaster. The government raised interest rates into the recession and let banks fail en masse. 2008 was a housing bubble combined with fraudulent mortgage securities and shadow banking collapse. Different mechanism, different causes, different policy responses. Grouping them together as the same pattern is like saying all plane crashes follow the same pattern. Technically, they all involve planes falling from the sky, but the causes, warning signs, and prevention methods are completely different. Problem 2. Survivorship bias. For every Joseph Kennedy who got out before 1929, there were dozens of smart investors who lost everything. For every Michael Burry who shorted the housing market, there were hundreds of hedge fund managers who tried similar trades and went bankrupt because their timing was wrong. The narrative only shows you the winners. It doesn't show you the countless people who followed similar strategies and lost everything because they were early or wrong or just unlucky. Problem 3. The certainty problem. This is the most dangerous part. The video states with absolute confidence, "We are in late stage 3 right now. The crash is coming within 6 to 18 months. No one knows that. Not Buffett, not Burry, not JP Morgan's analysts, not the Federal Reserve. In fact, JP Morgan Research reduced their recession probability from 60% to 40% in 2025. Goldman Sachs has similarly lowered recession odds. These aren't cheerleaders ignoring risk, they're analysts looking at actual data. Consumer spending, employment, corporate earnings, credit conditions. Could we have a recession? Absolutely. Could commercial real estate cause problems? Yes. Could regional banks face stress? Sure. But presenting this as a predetermined pattern that will definitely play out in a specific time frame is irresponsible. Problem 4. Ignoring base rates. Market crash predictions are constantly being made. Every single year, multiple hedge fund managers, economists, and YouTube personalities predict imminent collapse. Sometimes they're right, broken clocks and all that. But if you'd followed this advice over the past 15 years, constantly holding cash and waiting for the big one, you'd have missed one of the greatest bull markets in history. The S&P 500 has returned about 400% since 2009. Missing that because you were scared of a crash would have been catastrophic for your wealth. So why does this video get millions of views while sober market analysis gets ignored? Because it tells a compelling story. It's got heroes and villains, secret knowledge, a clear action plan. It makes you feel smart for seeing what others miss. It promises that if you just follow the pattern, you'll be rich while everyone else loses everything. That's intoxicating. It's also how people make terrible financial decisions. The reality of investing is boring. It's dollar cost averaging into index funds. It's maintaining diversification. It's staying invested through volatility. It's accepting that you can't predict short-term market movements. That doesn't get clicks. Buy VOO and hold for 30 years doesn't go viral, but it works. Study after study shows that time in the market beats timing the market. That the average investor who tries to move in and out of stocks based on predictions dramatically underperforms the market average. Okay, so if the 4-stage crash pattern is overblown, what should you do? First, ignore the certainty. Anyone claiming to know exactly when the market will crash is lying or delusional. Full stop. Second, maintain appropriate diversification. Don't have all your money in tech stocks. Don't have all your money in real estate. Don't have all your money in cash. Spread risk across asset classes based on your age, goals, and risk tolerance. Third, keep an emergency fund. 3 to 6 months of expenses in cash or equivalents. This isn't to prepare for market Armageddon, it's to prepare for life. job loss, medical emergency, car repairs. Boring stuff that actually happens. Fourth, if market valuations concern you, adjust gradually. If you think stocks are expensive, you can shift to a slightly more conservative allocation. Maybe move from 90% stocks to 80% stocks. That's reasonable risk management. What's not reasonable is going to 100% cash because a YouTube video told you the crash is definitely coming in the next 18 months. Fifth, if you're young, volatility is your friend. If you're 25 or 35 or even 45 and you're contributing to retirement accounts, you want the market to crash. You want to buy shares at lower prices. A crash when you're young and accumulating is one of the best things that can happen to your long-term wealth. Sixth, consider the actual risks. Commercial real estate stress is real. Some regional banks will face problems. Tariff policies create uncertainty. These are legitimate concerns, but they're not apocalyptic certainties. The financial system is better capitalized than 2008. Banking regulations are stronger. The Federal Reserve has more tools and more willingness to intervene. Could things go bad? Yes. Will they definitely go bad in exactly the way this video predicts? No. Here's what 1929 and 2008 actually teach us. Markets do crash, bubbles do pop, excessive leverage does unwind. That's real. But timing these events is nearly impossible. Even the people who got it right got lucky on timing. Burry was early on his housing shorts and almost went bankrupt before he was proven right. If he'd been 6 months earlier, his fund would have failed and we'd never have heard of him. The investors who build lasting wealth don't do it by perfectly timing crashes. They do it by staying invested through volatility, buying quality assets at reasonable prices, and letting compound returns work over decades. Buffett's real secret isn't a 4-stage pattern. It's buying good businesses at fair prices and holding them for decades. It's having cash available to be greedy when others are fearful, but not trying to predict exactly when that moment will arrive. The 4-stage market crash pattern is a compelling narrative. It's got just enough truth to seem credible and just enough drama to go viral. But it's not a reliable investment framework. It's financial content marketing designed to generate anxiety and engagement. Yes, Buffett holds cash. Yes, commercial real estate faces challenges. Yes, markets can crash, but no one knows when. Not with certainty, not with precision. Anyone claiming otherwise is selling something. Your job isn't to predict the next crash. Your job is to build a diversified portfolio appropriate for your goals, maintain it through volatility, and ignore the constant drumbeat of panic porn on social media. That's boring advice, but it's advice that actually works. If you found this helpful, let me know in the comments, and maybe share it with someone who's panicking about their investments because of viral crash predictions. Stay rational out there.